In 12 hours, nearly $300 billion vanished from somewhere and reappeared in silver. That's more than Finland's entire economy, moving into a single metal while you were sleeping. 2 major banks, same week, opposite warnings. One screams bubble, the other projects prices 20% higher. Shanghai is now paying $3.77 more per ounce than New York for the exact same metal. And China just announced something unprecedented. 0 delivery allocation, starting in 9 days. The question isn't what happened in those 12 hours. The question is what happens in the next 12 days. Welcome to John Analyst. If you've been watching the markets long enough to remember when a handshake still meant something in business, then you already know that what we're about to discuss isn't speculation. Before we continue, I'd appreciate it if you'd subscribe to this channel, not because I need the numbers, but because the professionals who understand what's coming tend to find value in having this analysis readily available. Also, drop a comment below and let me know where you're watching from. New York, London, Singapore, Mumbai? I'm genuinely curious where the serious minds are paying attention from. Now, let's decode what just happened. Market data revealed an anomaly on Tuesday morning that most investors missed entirely. In a 12-hour window between Asian close and New York open, silver's market capitalization expanded by $297 billion. That's more than the annual GDP of Finland, Portugal, or New Zealand. An entire nation's economic output, materializing in a single commodity in half a day. The price movement itself wasn't subtle. Silver surged 7 to 8% in that window. But the dollar magnitude of that percentage move is what demands attention. When a commodity with silver's market depth experiences a $300 billion injection in 12 hours, that's not retail speculation. That's institutional capital reallocation at scale. The professionals monitoring overnight futures saw it happen in real time. Asian exchanges lit up first. Shanghai Futures Exchange showed aggressive buying pressure building through the session. By the time London opened, the momentum was undeniable. And when New York traders arrived at their desks, the move was already complete. But here's what separates this from ordinary volatility. This wasn't an isolated spike. This was the continuation of a 5-day recovery pattern that has already reclaimed 35% from last Friday's overnight lows of $63.90 per ounce. Think about that recovery velocity for a moment. 1/3 of the drawdown. Erased in less than a week. That's not normal mean reversion. That's violent snapback pressure indicating something structural underneath the price action. The business community that lived through the 2020 monetary expansion recognizes this pattern. Gold behaved similarly in March 2020. Massive drawdown followed by explosive recovery as institutional money repositioned. But silver's recovery is showing even more violent percentage moves, because silver's available supply is dramatically smaller than gold's, while its industrial demand profile is exponentially larger. Now here's where the analysis gets uncomfortable for traditional market observers. The $297 billion injection happened while equity markets remained largely range-bound. The S&P 500 traded sideways. Bond markets showed minimal movement. Yet nearly $300 billion found its way into silver in 12 hours. That capital came from somewhere. It didn't materialize out of thin air. Institutional treasuries don't rotate $300 billion on impulse. They rotate when their risk models are screaming that current allocations are mispriced relative to forward probabilities. So what are those risk models seeing that retail sentiment hasn't processed yet? The answer isn't in the price charts. The answer is in the delivery mechanics breaking down across global exchanges. When the Shanghai Futures Exchange announced 0-lot delivery allocation for non-hedging participants, effective the last day of February, that wasn't a procedural update. That was an official admission that physical delivery capacity cannot meet paper contract obligations. Exchanges don't restrict delivery unless they're facing supply stress they cannot resolve through normal market mechanisms. And when you layer that restriction on top of the $297 billion capital injection, the picture becomes clearer. Institutional buyers aren't chasing price momentum. They're front-running a delivery crisis they can see building in the data. The professionals managing corporate treasuries understand something fundamental. In functional markets, price discovery happens through willing buyers, meeting willing sellers at clearing prices. But when exchanges begin administratively restricting who can take delivery, price discovery is no longer functioning. The posted price becomes increasingly disconnected from acquisition reality. And that's exactly what the Shanghai premium is signaling. Shanghai spot silver trading at $89.67, while Western spot sits at $85.90. That's a $3.77 premium for identical metal. The same asset, 2 different prices, based purely on geography and delivery jurisdiction. That premium isn't arbitrage opportunity. It's a warning. It's the market screaming that Eastern buyers no longer trust Western paper pricing mechanisms to reflect actual availability. They're paying more, not because they don't understand arbitrage, but because they understand that Western prices are increasingly fictional constructs maintained by derivative contracts rather than physical clearing. For the business community managing supplier contracts, strategic reserves, or treasury operations, this creates immediate operational risk if your contracts are priced in COMEX silver. But your actual acquisition costs track Shanghai premium pricing, your budgets are wrong, your forward projections are wrong, and your hedging strategies are calibrated to a pricing mechanism that may not survive the next delivery pressure test. The data doesn't lie, but it does require interpretation. When nearly $300 billion flows into a commodity market in half a day, the question isn't whether something is happening. The question is whether decision makers are equipped to understand what that something means, and whether they're positioned accordingly, or waiting for consensus confirmation that arrives after prices have already moved. There's a principle in global markets that most business professionals take for granted. The principle is simple. An ounce of silver in Shanghai should cost the same as an ounce of silver in New York, adjusted for shipping, insurance, and transaction costs. The price should converge within a narrow band. This isn't economic theory. This is arbitrage mechanics that have governed commodity markets for over a century. When prices diverge beyond transaction costs, traders buy in the cheaper market, sell in the expensive market, and the spread collapses back to equilibrium. Except that's not happening anymore. And the breakdown of this fundamental mechanism is revealing something far more significant than a temporary dislocation. Right now, as of the most recent exchange data, Shanghai spot silver is trading at $89.67 per ounce. Western spot, COMEX, and London pricing shows $85.90. That's a $3.77 premium, not for different grades of silver, not for different delivery time frames, for the exact same physical metal. A 4% price differential that persists day after day, despite every textbook arbitrage mechanism theoretically available to collapse it. Professional traders see this data and immediately ask the obvious question. Why isn't someone buying Western silver at $85.90, shipping it to Shanghai, and selling it at $89.67 for a $3.77 instant profit? The answer is becoming uncomfortable for those who still believe paper markets control physical reality. They can't, not at scale, not reliably, not anymore, because the Shanghai Futures Exchange just made an announcement that changes the entire delivery infrastructure. Effective the last day of February, 9 days from now, participants without hedging quotas receive zero-lot delivery allocation on all silver contracts. Zero. Read that again slowly. If you're not classified as a hedger with approved quotas, you cannot take delivery. Your contract settles in cash, regardless of what you actually need. This isn't a minor procedural change buried in exchange documentation. This is the second largest futures exchange in the world officially admitting we cannot deliver physical metal to everyone holding paper claims. Exchanges don't implement delivery restrictions when everything is functioning normally. They implement restrictions when the gap between paper promises and physical reality becomes unmanageable. And here's what makes this restriction particularly revealing. It's not temporary. It's not tied to a specific contract month. It's structural policy going forward. The Shanghai Futures Exchange is fundamentally restructuring who has delivery rights, because they've recognized that open delivery to all participants creates a run-on-the-bank scenario they cannot survive. Now layer that on top of another data point most analysts are ignoring. In the past 7 days, SHFE has suspended 20 account groups for trading violations. 20 accounts, 1 week. On a major global exchange, professional traders who've operated in commodity markets for decades will tell you they've never seen enforcement at that pace. Exchanges don't suspend 20 account groups in 7 days unless something is breaking down at the operational level. Those suspensions aren't about protecting market integrity. They're about controlling delivery pressure before it spirals into crisis. Meanwhile, 6,000 miles away in New York, COMEX is experiencing its own delivery stress signals. 861,000 ounces of silver left COMEX vaults in a single 24-hour period this week. That's not normal inventory fluctuation. That's one of the largest single-day withdrawals in recent exchange history. And it's happening while open interest sits at 68,000 contracts, which represents roughly 340 million ounces of paper silver claims. Registered silver actually in the vaults? 101 million ounces. The math is simple. 3.4 paper claims for every 1 ounce of physical metal. That ratio works fine, as long as everyone agrees to accept cash settlement instead of demanding delivery. But the moment a meaningful percentage of contract holders say, no, we want the actual metal, the entire pricing mechanism breaks, because you cannot deliver what doesn't exist. And this is where the Shanghai premium becomes a strategic warning rather than a curiosity. Eastern buyers are paying $89.67 not because they enjoy overpaying, but because they've concluded that Western paper pricing at $85.90 is fictional. They're paying the premium for guaranteed physical delivery, because they understand that COMEX settlement at $85.90 might give you dollars, but it won't necessarily give you silver. The fracture between East and West pricing isn't closing, it's widening. And every day it persists. It confirms that two separate silver markets are emerging. One market is paper contracts, traded electronically with infinite leverage and cash settlement. The other market is physical metal with delivery restrictions, premiums, and allocation quotas. For corporate treasurers managing industrial silver requirements, for manufacturers dependent on reliable supply chains, for strategic planners modeling forward costs. This fracture creates a scenario that spreadsheets aren't built to handle, because if Shanghai pricing represents actual acquisition reality, and New York pricing represents derivative settlement fiction, then every budget calibrated to COMEX prices is systematically underestimating true costs. The professionals who recognize this early adjust their models, lock in supply agreements, and position before the consensus catches up. The ones waiting for the fracture to resolve naturally may discover that fractures don't heal, they widen, until something breaks completely. There's a moment in every major market transition when the facade of institutional consensus begins to crack, not dramatically, not with headlines screaming crisis, but quietly, through contradictions that careful observers recognize as something far more significant than analytical disagreement. Last week provided exactly that moment. Two systemically important banks, both with multi-trillion-dollar balance sheets, both with research teams considered among the most sophisticated in global finance, both analyzing identical data sets, issued guidance so fundamentally opposed that only two explanations are possible. Either one of them is catastrophically wrong, or something underneath the market structure is shifting faster than their models can process. Bank of America published their updated bubble risk indicator. It's a proprietary metric they release weekly, designed to flag assets showing characteristics of unsustainable price expansion. The list published last Tuesday included U.S. material stocks, gold, silver, and South Korea's cost-buy index. Their warning was explicit. AI-driven innovation could fuel more unstable, bubble-prone markets going forward. The implication is clear. Metals are overheated. Profit-taking is advisable. Risk management protocols suggest reducing exposure. That guidance hit Bloomberg terminals on Tuesday morning. 72 hours later, Wells Fargo's commodity research desk published their updated 2026 precious metals outlook. Their new price target for gold, $6,100 to $6,300 per ounce. That represents more than 20% upside from current levels. Their reasoning? Geopolitical fragmentation, persistent market volatility, and what they specifically called structurally strong central bank demand. Wells Fargo didn't just raise their target. They explicitly characterized the recent pullback in gold, the same pullback Bank of America flagged as bubble behavior, as a healthy correction after a sharp rally. Translation: Wells Fargo is telling institutional clients, this is a buying opportunity. Same week, same market. Opposite instructions. Now, for retail investors conditioned to trust institutional guidance, this creates confusion. Which bank is right? But for professional capital allocators who understand how these research desks actually function, the contradiction reveals something more important than directional calls. It reveals that the institutional consensus framework is breaking down. These aren't boutique research shops issuing speculative analysis. These are institutions that manage trillions in client assets, whose research directly influences pension fund allocation, sovereign wealth positioning, corporate treasury strategy. When institutions of this scale publish opposing guidance in the same week, it signals that their underlying models are processing the same data and arriving at incompatible conclusions. And that incompatibility suggests the data itself is behaving in ways their historical frameworks cannot accommodate. Here's why that matters for decision makers outside the financial sector. Institutional research models are built on historical correlation assumptions. They assume markets behave within statistically predictable boundaries. They assume pricing mechanisms function according to supply-demand equilibrium. They assume that arbitrage opportunities collapse quickly. They assume that physical and paper markets remain tethered. But when those assumptions begin breaking down, the models don't just get noisy, they start producing contradictory outputs. Bank of America's bubble indicator is flagging price velocity and volatility metrics that historically preceded corrections. Wells Fargo's fundamental analysis is flagging structural supply deficits and monetary policy trajectories that historically preceded sustained bull markets. Both are technically correct. Both are analyzing real data. But they're measuring different aspects of a market that's no longer behaving cohesively. And there's a third institutional voice that appeared in the same week, one that most business professionals missed entirely because it was buried in paragraph 7 of a broader story. Bloomberg Television ran coverage of Lunar New Year demand in Hong Kong, standard holiday feature, retail buyers purchasing gold bars and coins as gifts, trading volumes up versus prior year, exactly the kind of seasonal color piece that fills airtime without making news. Except in the middle of that coverage, Bloomberg's correspondent made a specific statement. Supply constraints, especially in silver, are raising concerns about whether the momentum can last. That's not speculation from alternative media. That's not conspiracy theory from internet forums. That's Bloomberg, mainstream financial media with institutional credibility, admitting on air that silver supply constraints are real. They buried it. They framed it as a concern about demand momentum rather than a supply crisis. But they said it, and the professionals who actually read past headlines, who parse language carefully, who understand how institutional media signals information without triggering panic, they caught it. Because Bloomberg doesn't acknowledge supply constraints in a globally traded commodity unless those constraints are beyond disputing. Now here's where these three contradictory institutional signals converge into strategic insight. Bank of America warns bubble. Wells Fargo projects 20% upside. Bloomberg admits supply constraints. The common thread isn't in their conclusions. The common thread is that all three are acknowledging something abnormal is happening. They're just framing it through different institutional lenses. Bank of America's risk management protocols require them to flag volatility. Wells Fargo's commodity desk is responding to central bank buying and geopolitical demand. Bloomberg is reporting physical market stress their sources can no longer deny. None of them are lying. But none of them are telling the complete story either. Because the complete story requires acknowledging something that institutional frameworks are not designed to process. That paper pricing mechanisms and physical delivery capacity have diverged to the point where they're no longer describing the same market. For business leaders navigating this environment, the lesson isn't to pick which institution is correct. The lesson is to recognize that when major institutions cannot align on fundamental market direction, the market itself is transitioning between states. And transitions are where the most significant wealth transfers occur, not because of superior forecasting, but because of superior pattern recognition. The professionals who positioned for gold's decoupling from equities in 2019 didn't need Wells Fargo's permission. They saw central banks buying, they saw negative real rates, they saw dollar devaluation mechanics, and they positioned before institutional consensus formed. The same pattern recognition is required now because institutional contradiction isn't noise to be filtered out. It's signal indicating that the rules governing price discovery are changing, and the question is whether decision makers recognize that change early or wait for institutional consensus that arrives after the transition is complete. Every financial system operates on foundational assumptions that participants rarely question. One of those assumptions has governed commodity markets for the past 50 years. The assumption is simple. Paper contracts and physical metal are functionally equivalent. A futures contract representing 100 ounces of silver and 100 actual ounces of silver sitting in a vault are treated as interchangeable instruments for pricing purposes. This equivalence has allowed markets to function with extraordinary efficiency. Traders can gain exposure without storing metal. Producers can hedge production without immediate delivery. Consumers can lock in prices without taking possession. The entire modern commodity infrastructure is built on this paper physical equivalence. But that equivalence requires one critical condition to remain true. The paper claims must remain convertible to physical metal on demand. The moment that convertibility becomes uncertain, the entire pricing mechanism begins to fracture. And right now, across multiple exchanges simultaneously, that convertibility is being quietly restricted. The data is public. The mechanisms are documented. But the implications are being systematically underestimated by those who still believe markets self-correct automatically. Start with the most basic metric. COMEX, registered silver inventory versus open interest. Registered inventory represents physical metal available for delivery. Current level, 101 million ounces. Open interest represents the total number of outstanding contracts. Current level, 68,000 contracts. Each contract represents 5,000 ounces. The math is straightforward. 68,000 contracts times 5,000 ounces equals 340 million ounces of paper claims. 101 million ounces of physical backing. That's a coverage ratio of 3.4 to 1. 3.4 paper claims for every 1 ounce of registered metal. Now, in normal market conditions, that ratio isn't alarming. Most contracts settle in cash. Most traders never intend to take delivery. Most hedgers roll contracts forward rather than standing for physical. The system works fine, as long as everyone agrees to play by those rules. But 861,000 ounces left COMEX vaults in a single day this week. That's not contract rolling, that's physical withdrawal. And it's happening while margin requirements have been increased, while delivery restrictions are being implemented in Shanghai, and while Bloomberg is acknowledging supply constraints on mainstream media. The pattern is unmistakable to anyone who's studied previous delivery crises. When vault inventory declines while open interest remains elevated, when exchanges begin restricting delivery allocation, when premiums emerge between Eastern and Western pricing, these aren't isolated data points. These are sequential indicators that physical delivery capacity is becoming constrained relative to paper claims. David Jensen's recent analysis frames this pattern in language that business professionals need to hear. His assessment is direct. The rapid decline of Western vault stocks and surging lease rates indicates metal is flowing eastward as all vaults are rapidly depleted globally. Not just COMEX, not just LBMA in London, all vaults simultaneously. And his conclusion on supply response is equally clear. Overconsumption and underproduction of silver globally for decades means an increase in supply to market will require much, much higher prices. Translation: the supply deficit cannot be resolved at current price levels. Mining production cannot scale quickly enough to meet industrial demand. Above-ground inventories are depleting across all major storage locations. And the only mechanism that balances supply and demand in this scenario is price. Significantly higher price. Now layer geopolitical fragmentation on top of these supply mechanics. China's share of U.S. imports just hit a 26-year low. That's not a single-year anomaly. That's 5 consecutive years of deliberate decoupling. The supply chains that connected Western consumers to Eastern production for 3 decades are being systematically rerouted. And in that restructuring, China is implementing export controls on strategic metals, not as temporary trade negotiation tactics, but as permanent resource nationalism policy. China controls 70% of global refined silver supply. When a nation controlling 70% of a critical industrial input begins restricting exports, that's not a trade dispute, that's economic warfare. And the Shanghai premium that persists at $3.77? Is the market pricing in that new reality? Eastern buyers aren't paying premiums because they're uninformed. They're paying premiums because they understand that access to physical metal is becoming jurisdiction dependent. Paper contracts settled in New York might deliver dollars, but they won't necessarily deliver silver. Not at scale, not reliably. Not when the nation controlling 70% of refining capacity has strategic reasons to restrict flow. For corporate treasurers managing industrial silver requirements, this creates a scenario that traditional procurement models cannot handle. If your manufacturing process requires silver and your supply agreements are priced off COMEX futures, you're calibrating costs to a pricing mechanism that may not reflect actual acquisition reality. The gap between paper settlement price and physical procurement cost is the hidden tax that shows up when contracts need to be converted to actual metal. And that gap is widening. Now here's the framework that puts all of this into strategic context. Daniel Oliver from Momentum Capital recently published analysis on dollar endgame scenarios. His thesis is mathematically straightforward. The United States faces a binary outcome. Either the government defaults on debt obligations, or the Federal Reserve is ordered to purchase treasuries at scale, monetizing debt and destroying the dollar through infinite expansion. There is no third option that maintains current fiscal trajectories without one of those two endpoints. Whether his specific timeline proves accurate or not, the directional thesis is becoming harder to dispute. Debt to GDP ratios are at historic extremes. Interest expense is consuming increasing percentages of federal revenue. Entitlement obligations are accelerating faster than economic growth. The mathematics don't balance without either default or monetization. And in that endgame scenario, hard assets with industrial utility become the only reliable store of value. Gold serves as monetary insurance, but silver serves a dual function: monetary hedge plus industrial necessity. Solar infrastructure requires silver. Electric vehicle production requires silver. AI data centers require silver. 5G networks require silver. Military applications require silver. These aren't discretionary uses that decline during economic stress. These are structural dependencies that intensify regardless of monetary policy. And unlike gold, silver is being consumed in industrial applications that remove it from available supply permanently. It doesn't sit in vaults waiting to be recycled. It's integrated into products at quantities too small to economically recover. That consumption dynamic, combined with the coverage ratios at COMEX, the delivery restrictions in Shanghai, the vault depletion documented by David Jensen, the geopolitical fragmentation driven by China, creates a convergence that professional risk managers recognize as a structural break, not a temporary dislocation, a permanent separation between paper pricing and physical reality. The business community that positioned early for previous transitions didn't wait for institutional consensus. They identified structural breaks in the data, verified the information through primary sources, and allocated before the majority recognized what was happening. The $297 billion that moved into silver in 12 hours came from institutional capital that had already completed that analysis. They didn't wait for Bloomberg to explain it comfortably. They didn't wait for Wells Fargo and Bank of America to align their guidance. They saw the coverage ratios, they saw the delivery restrictions, they saw the Shanghai premium, and they positioned accordingly. The data is public. The exchange announcements are verifiable. The vault inventories are reported daily. The question isn't whether this information is accessible. The question is whether decision makers are analyzing it or waiting for permission to act from institutions that issue contradictory guidance in the same week. Because by the time institutional consensus forms, by the time mainstream media moves the story from paragraph 7 to headline coverage, by the time comfortable narratives emerge that don't challenge existing assumptions, the positioning window closes, and the professionals who recognize the structural break early are already positioned, while the majority is still debating whether the data is real.